Hello, everyone. Thank you for coming tonight. We are now going to get started for our seminar on Social Security and Medicare Basics. Before we get going, I want to introduce myself and wanted to also kind of discuss some housekeeping items for tonight. So, my name is John Briggs. I think most of you got a bio from me, as well as many of you got a phone call. I am a CFP as well as the partner in an RIA firm and an independent registered investment advisor. The firm's name is Palmacy Wealth Management. The plan tonight is to cover Social Security as well as Medicare Basics to make sure that you guys have a firm understanding on Social Security, how it works, how your numbers are calculated. Should you take it now? Should you take it later? There's going to be a lot of questions like that, as well as some Medicare basics. And then at the end, you'll see I'll wrap it all together on how to really create a great retirement plan for you and or your spouse. So tonight, like I said, we're going to cover some basics. We're not going to have time, unfortunately, to be able to cover everybody's individual questions. There is a chat box on there on the program on the right-hand side that you'll be able to ask questions. I think many of you had sent some questions ahead of time. I won't have time to be able to discuss those tonight, but what I plan to do is put those all in a file for each one of you, and at the end, you're going to see a link. So this part, like I said, is part one in the email. Part two is to set a time to actually go over your particular situation and be able to cover all those questions more in depth. I usually schedule, and you'll see there's a link on the bottom. It's called Calendly. You'll see on there that I'm scheduling 30-minute new client consults. So if you would, at the end of this, please click on that. I'd really like to have a time to cover your individual situation. I really like to keep this, like you saw in the email, very short and sweet. I want to keep this presentation to about 30 minutes, get you back to your evening, get you back to your family time. And instead, let's spend 30 minutes after this meeting getting together and actually discussing this more thoughtfully about your individual situation. At the end of all this, my plan and what we do with all of our clients at the end of these is set a time to go over not only Social Security basics questions that they have, but also actually firm up a Social Security analyzer to find out when really is the optimum time based on family history, your own current situation to take Social Security for both you and your spouse. Like you'll see in here, there's actually some really great ways to be able to take Social Security and to really maximize that dollar value. And then also most clients at the end, what they'll also ask as part of our consult is to talk a little bit more about their financial situation. So as I mentioned before, and you can probably see the degree up there, I do have my certified financial planner designation. So the big key there is that you're not just an investment advisor. You're not just an insurance person. You're not just somebody that can give education. You're supposed to be able, as a CFP, you take classes in multiple different areas to be able to really understand each area well. Tax, Social Security planning, income planning, to really be able to comprehensively give clients really thoughtful advice on how to retire successfully. So without further ado, let's get started. So as you can see here, the idea for tonight is to get a closer look at your Social Security benefits. It doesn't cover it on here, but again, there's going to be Medicare basics at the end of this as well. So today, everybody's in an interesting situation. The people of yesteryear, if you want to say it that way, most of them had a really, really big pension. Most of them had some sort of benefit that they would get from their employer. Nowadays, you'll see on the other side, most employers either don't have a pension at all, or those numbers are significantly different. There was a time, I'm spending most of my life in upstate New York, that Kodak was a massive employer. And they had people retiring at a very young age, and they were paid for 30 or 40 years a pension because they had worked, from age 20 to age 50, let's say. So those days I don't really think are there. There's going to be some clients in here that do have pensions. I really applaud that. I think that's great. You guys put in a lot of years to get that pension. But for the most part, what you'll see is you're in charge of creating your pension in the form of having money saved away as part of your nest egg. So on here, you'll see Social Security really plays the same role it always has played, but you'll see that now there's really very few pensions, and it's all about that 401k, 403b IRA. So that's going to be kind of your own personal pension. You'll see at the end how there's a lot of different strategies, and we can talk more one-on-one on our consultation on how to create a pension for yourself that your employer, you always wish you had from them. So because of that, what you're going to see, we'll take a look at your Social Security statement. Social Security is never really meant to be 100% of your retirement earnings. Actually, if you see it on here, it should only really replace about 40% of your pre-tax earnings in retirement. So the idea behind it is it's supposed to be there to suffice, for a lot of your expenses, or for at least a set expense. It's not meant to be everything for you. The real key behind it is, how do you create, and you'll see that at one of the last slides, how do you create enough income between your Social Security, your spouse's Social Security, probably a pension that you don't have, and this big lump sum of retirement money. So you'll see on here, 40%, for most people, I don't think they could live on 40% of their budget, even at bare expenses. So the idea is that you're going to be in charge of creating your own. So this is your Social Security statement. Most people have seen these. You're not getting these in person the way that you used to get these in person. You're getting them infrequently, for the most part. Most people nowadays have to go on SSA.gov and really create an account and go in and log in that way. If you see down here, the big question that a lot of clients have is what happens, is Social Security going to run out? What happens if I go to collect and there's no money there, or there's not enough money there? The key being, and you're going to see these on all your Social Security statements, the key being that there's enough current payers in the system so that up to 2034, everything's covered. After 2034, 79 cents on a dollar is covered. So the tough part, Social Security, is when it was originally made, people didn't live as long, and there were a lot more workers versus those collecting. Nowadays, you've got a lot of collectors and not as many workers, and people are living a long time, so that big chunk of money that was there is starting to really dwindle down. So I do want to pause for a second and say I don't believe that Social Security is going to run out. Anyone that I've talked to, that the consensus has been from a lot of these larger companies that what will probably happen is that people down the line, people that are maybe under age 50 now, will start to see a difference either in pushback in age, difference in benefit, maybe more of a needs-based Social Security, maybe more taxes going out of their paycheck to create a higher Social Security. But for the most part, those that are close to collecting won't really see a large benefit. That would be a massive, massive issue if everybody started to have a huge, 21% reduction in their Social Security. That would be a big problem. So the next piece here is how are your Social Security benefits determined? So to become eligible, and then how is it based on? So to become eligible, you have to have worked for 10 years. You have to have 40 quarters, so 40 quarters of a year, and so that equals 10 years in total of wages that are subject to Social Security earnings. Pretty simple. They don't have to be in a row, so you can have a big block of time that you didn't work, you stayed home with the kids, you were without a job, whatever that happens to be. Maybe you're retired and then went back to work, at an early age. And then the quarters do not expire; they always stay on. So even if you had a paper route back in the day, if you paid Social Security in there, those numbers are going to be on there. Now, how is your Social Security calculated? So your Social Security is actually calculated on your 35 highest working years. And then you think about, back in the day, the 80s and 90s, early 2000s, maybe you weren't making the dollar value you are today because of inflation. That's also calculated in there, so no worries on that. They do take a look at your previous earnings. They do boost that up to today's dollars so that the equation is a little bit easier. But it is your 35 highest working years. Question being, I got 25 years, what happens to me? 10 of your years count as zeros. Obviously, that's not a great thing for the formula, but it does mean that you still are eligible because you've had 10 years of work experience. So what we typically look at with clients is make sure you know your numbers. If you have a significant other maybe that stayed home or you didn't work, We'll talk a little bit about some of the spousal options, but those that did work, if you're at 33 years versus 35 years, if you're at 30 versus 35, if you got a few years in there that are really, really low numbers, we can help talk to you a little bit about how much your numbers are going to be boosted by getting those full 35 big working years in there. And it does make a difference, and that's a little bit of difference for all of your life and maybe even some of your spouse's life. So it does make a difference. Next slide. So most people are saying, okay, so what is full retirement age, right? When am I eligible? So I want to be clear with everyone. You are eligible as a single person as early as age 62. But your full retirement age is calculated based on your year of birth. So if you were born between 43 and 54, you're at 66 clean. Every year after that, up until 1959, you are 66 and 2 months, 66 and 2 more months. So you'll see on here, there's ages for every single person, with the idea being that if you're born in 1960 or later, so regardless if you're born in 1980, if you're born in 1970, 1961, everybody has that same, right now, same retirement full age, meaning age 67. So all full age means is that's when you collect your full benefit. So it does not mean that that's the age you have to wait to. It just means that that is the full benefit. So some people are saying, well, I'm worried about Social Security. I'm thinking about retiring early. Should I take my benefit? So I want everybody to know out there, like I said, your Social Security is eligible. You are eligible for it as early as age 62. What you'll see here is it's a massive reduction. So if you are born in the years where clean age 66 is your Social Security full age, you'll see that if you take your benefit as early as age 62, if you're supposed to get $2,000 a month at your full age, you're going to lose $500, $6,000 a year that you're going to lose for the rest of your life, and maybe even in your spouse's life when we talk a little bit about how that works when the first spouse passes. So that's a massive reduction, not meaning that it's not the right plan. And again, there is no right answer. It's really based on what do you have going on, when are you going to retire, what's your health look like, what's family history look like, and then the other question will be is, well, if I delay, what do I got to take out of my nest egg to make sure I can live? That money's got to come from somewhere, right? So if you're age 67, there's no middle ground here. Obviously there is, but there's no middle ground on this chart. If you're age 67, it's actually a 30% reduction. So again, it's something to think about that a lot of people really aren't thinking. They're just saying, I'm retired, I'm going to pull the trigger. There's some planning that can be done so that you can get, especially if this is 2 people in a household where one can take it early, one person can delay. There's some really great strategies that I can help you with to be able to really maximize that end dollar without having to take so much money. Everybody worries about taking a lot of money out of their nest egg. I also wouldn't delay and take a ton of money out of your nest egg. So there's kind of a sweet spot with some of that. I'll show you that based on your specific figures once we sit down one-on-one. Next one, taking benefits and working. So a lot of clients don't really think about this or don't really know this. I can tell you before we go into this, I had a client that for many years, many years was kind of counting down the days till he could retire. And when he finally did retire, he about lost his mind. Couldn't stay at home. It was the winter time. There was a chunk of time where his wife was a teacher and she'd already been retired, and he could not enhance her retirement. If anything, he was actually making her retirement worse. So we ended up going back to work and getting a full-time job. Even though we had chatted about not taking Social Security, he did it anyway. And honestly, I think it hurt their scenario by him taking it at 62 and then going back to work. You'll see this on here. He always had to play that game of here's how many hours I can work this year so that I don't go over the limit. So really, I really seriously suggest if you're going to retire at 62, wait to 62 and 6 months. Wait till you've been retired for a little while to be 100% sure that you want to stay retired. You don't want to go back and work part-time. You don't want to deal with any of that stuff. So, because here's why. So at full retirement age, there is no penalty for you taking your full retirement age Social Security. There's no penalty, there's no give back, there's no issues with anything. And the year that you turn your age, so let's say 66 is your full age, the year you turn 66, you actually give $1 back in benefit for every $3 you earn over 46,920. So again, 46,920, that's probably better than a part-time job for most people. But it is something to keep in mind. Be really cautious about taking and trying to double dip work, a full-time gig, as well as do this, because what you're doing is you're taking some money out of what could be your full retirement or a delay on Social Security, and instead you're giving back $1 for every $3 you earn over that. Just not worth it. The really big one is this, so under full retirement age. So like I said, the example being 62, having your full age being 66, the biggest concern with that is actually you give $1 back in benefits for every $2 you earn above 17,640. So again, $17,640. So for a lot of people, they're definitely making more than that as a full-time wage. If they're going back part-time, there's a lot of clients that are going to make more than that working part-time. So they really need to be cognizant of the fact that there's this income value out there, and not only are they taking a 25 or even 30% haircut depending on their full retirement age, they're also having to pay back Social Security. It's insane. So be really cautious about that. There's some ways and some planning to do that. Like I said, the biggest key being wait to be 100% sure that you actually want to stay retired, that you don't want to go part-time, that you don't want a contract job back at the old employer. Make sure you're 100% sure that you're done, right, before you pull the trigger. So just like there's a penalty for taking it early, there's actually an enhanced benefit for those that delay. So take a look at this for 1 second. You'll probably see the chart. The key behind this is the answer isn't just delay all your Social Security to age 70. That is not the answer. That is very unlikely the answer that you would get based on doing a consultation with me. What you would likely find is, again, a delay of one and a taking early of another. For age 66, if you take a look at this here, at age 70, it's a 32% increase. So on a $1,000 Social Security, that's a $320 per month increase for the rest of your life. Obviously, with this side being age 67, it is a little bit different. You are already past this age 66 full age, so you only get a 24% increase if you wait till age 70. But again, on a $1,000 value, that's another $240 increase. So there are advantages to delaying, but the key behind it being is that there's no boilerplate answer. It's not everybody should just delay as long as they can. Again, it's all about sitting down with somebody, running a Social Security break-even analyzer like this, where it shows you when to retire, when to take Social Security, and what your break-even points are. So you can make a really educated decision on when your Social Security, when you should pull the trigger on Social Security. If you can see on here, the advantages of delaying. So if you claim at age 62, if you claim at age 66, if you claim at age 70. So it shows, let's say your full Social Security age was 66, and you were going to get a $2,000 payment. If you took it at 62, 25% decrease, so you're going to see a $1,500 a month Social Security benefit. If you waited to 70, in that case, you would see a 32% increase. So you're going to see a $2,640 Social Security. If you take a look at this here, you're going to see this cross point right here. And the cross point basically says, if you can live past age 80, here's the right call. So what it says first is, if you can live to age 78, here you are better off taking it at full age versus taking it at age 62. So take it at 66 instead of 62 if you can live to 78. On the other side, if you can live to 82, you're actually better delaying it to age 70. So again, taking it 12 years versus taking it for 16 years, you're actually better off waiting to age 70 and taking that higher payment, even if you only live to age 82. When you look at a household, healthy individuals, both of you guys, pretty close to Social Security age, it's not impossible by any means to see at least one of the two spouses live till age 84 for sure. So this again shows, all these figures that we're talking about and the break-even points. And my key here is, I don't want to bore you with that particular situation because it's not yours, right? The key is, let's sit down and go over your particular situation. I have the software to build a Social Security analyzer for you, and let's make an educated guess. Taxation of Social Security. So everybody's used to getting $1,000 of wages and being taxed on basically the whole $1,000 of wages. The major difference with Social Security is that the highest amount that is taxable is 85%. So no, not tax rate of 85%. 85% of your Social Security is considered taxable earned income. So if you had $1,000 Social Security payment, only $850 would actually be included as taxable earnings towards whatever tax rate you do pay. So there's a little bit of a tax break there. The key to look at here is, this is single and this is married filing joint. The key to take a look at is if you can keep yourself, and we'll cover some of this here. This is provisional income, a lot of fun stuff on this side. It tells you what's included, what's not. The key being here, let's sit down and go over your situation, because there's actually brackets where either none of your Social Security is taxable, only 50% of your Social Security value is taxable at ordinary income rates. And then, like I said, the highest one is 85%. So sometimes you can keep yourself, at least for a few years, in that 50% being taxable in Social Security. That's a massive break versus the wages you're used to doing. So the key to this slide being, let's sit down, let's go over your situation. I can talk you through and do a tax table with you, the situation, and give you an idea of whether or not you'd be at 85, which is still great, versus what you're seeing today, or you could even be at 50 or 0% of your Social Security being considered earned income. So collecting benefits from a spouse. So if you look at spousal benefits, if you look at survivor benefits, there's some similarities and there's some differences. So spousal benefits, meaning I want to collect off a spouse, right? I want to collect off a spouse or an ex-spouse. The idea being survivor benefit is your spouse has passed. The big key here, and again, I don't want to spend too much time on this. If you're a divorced spouse, if you are a widow or widower, let's sit down and go over your situation a little bit more in depth. There's not going to be a ton of you guys on this scenario that actually can get these benefits from an ex-spouse or from being the surviving spouse. But if you are in that situation, there are some different things that are available for you to either collect off of that ex-spouse, or if you're a surviving spouse, collecting Social Security as early as age 60. Yes, 60, not 62. That's one of the only scenarios that you can take at age 60. So there's some issues, there's some caveats, there's some stuff you need to know. So again, not to spend too much time on it because it's going to be a small percentage of the crowd, but let's get together and go over it. Spousal benefits, regular spousal benefits. So the key being here is, let's say you were a stay-at-home spouse, or let's say you don't have a great earnings record. You are eligible to collect off of your current spouse. My wife, Jamie, stays at home with the kids, and obviously that may change at some point. We're still pretty young, I'm 32. But the idea being is, let's say she never went back to work. She decided to get involved with the kids and the school and be involved with that more than going back to work. She's eligible to claim off of my earnings history. So even though there's only one person working, if she takes Social Security at her full age, like I would take my full age, she's actually eligible for 50% of my payment that won't affect my payment. So again, 50%. So if, let's say, my full Social Security age is 67, which I think being 32 would probably be more than 67 at some point, but right now it's 67. At age 67, let's say she goes and claims Social Security off of mine. Let's say my payment was going to be $2,000. She would actually get $1,000 on that payment with the current laws. So meaning our household would receive $3,000 a month in Social Security benefits, even though I may be the only person that's actually worked, outside of the home. So again, there's some caveats to that. You can't claim before your spouse claims. There's some pieces to take a look at, and there's going to be a lot of things to look at on whether or not your earnings history might be worthwhile taking. There's some people that have 15 years, let's say, of working history that actually might have a higher Social Security than half of their spouses. So again, that's something that we got to take a look at and figure out if that's the right scenario, or what's the Social Security benefit for that spouse to take. Does it make sense to take their own? Does it make sense to take off their current spouse? Just so you know, just like everything else, there's always penalties for taking early. So like I mentioned, if full retirement age is for Jamie and I is going to be age 67, and there's at that time period she'd be eligible for 50%. That $2,000 payment, she gets $1,000 a month on her own benefit, off of mine. If she took it at age 62, and let's say there's an age difference enough where I'm already claiming, because again, that's the key, she would only get 32.5% of my Social Security. So just to put that into kind of a number that makes some sense, instead of getting $1,000 a month, she would get $650 a month. Great. I mean, it's money that we didn't have before, and it's money that honestly wasn't claimed as part of her particular check. It was kind of claimed almost off of my check. But it is one of those things that you really should take a look at the scenario and figure out: are you better off taking that early? Should you delay? There is a significant decrease, obviously, in $600, $650 a month versus $1,000 a month, right? Especially with that being for the rest of our lives. Let's say you live to 90. That's 23 years of payments, that are going to be a, $300 difference. So it is something to, again, take a look at when you're taking a look at all these. There's a lot of really big decisions you have out there when it comes to Medicare and Social Security. And all, I can say for that is to make sure that you're getting with somebody that's educated, that can give you really great advice. That's why I sent out that bio ahead of time. I want to make sure that that I'm a professional, I've got the background of it, and I'm good to give that advice. Survivor benefits, again, don't want to spend a lot of time on this, but there is that age 60 that you can take that money. There is some money even out there for minor children. So there's some pieces out there to take a look at. If you do have a spouse that passed, there is money out there for you to take. And again, as that income earner, you can actually get it at age 60, which is, like I said, the only scenario where you can take it before 62. So Social Security and other pensions, again, because it's not going to be a vast majority of those people out there, I'm going to cover it really quickly. If this is you, let's chat one-on-one. Government pension offset windfall elimination. So the key being here, there are some people out there that their pension and their Social Security are sort of tied together. They can only get a certain amount of Social Security benefits because their paychecks all those years did not include Social Security taxation. So there are some pensions out there, there's some government employees, I think specifically of those who were postal workers, things like that, that over the years may not have been eligible for both a pension payment and Social Security. Again, those people are few and far between, but if you're one of them, I do know what you're talking about and I can help you. Last but not least, Medicare basics. So a couple slides on here to talk about Medicare. So some people are actually going to be eligible for Medicare and they get automatically enrolled. Other people need to sign up. The major part that we're talking about today is Part B. That's the part that costs you some money, typically through your Social Security. If you don't sign up when you're first eligible, I wanted you to know that there's a penalty. They call it a late enrollment penalty. Again, there's some stipulations around that. If you're already covered by an employer plan, there's some ways to get around that enrollment penalty. But if you are eligible and you're retired and you didn't pull the trigger on it, you're probably going to get a late penalty. So if you're getting around that age, it is time for you to pull the trigger on getting that Medicare Part B. Part B premium. So a lot of people get the idea of Part B premium and, hey, everybody pays the same. You'll see on the next slide that's not true. There's something called IRMAA, and no, that's not your aunt. It's somebody else that is actually just going to take extra money from you every month. So Part B does cost something. There's some people that are not eligible to pay premiums. I did, like I said, postal workers. I did have a postal worker that didn't have to pay into the Part B premium. It was actually covered for them. So again, everybody's got a different scenario. There's some examples out there of some of these, but for the most part, everybody's going to be paying the dollar value that they're supposed to pay based on earned income. So if you're an individual filer, 87 grand or less, and yes, that is adjusted gross income. So again, talk to me afterwards if that's a question on there, but that means after your personal exemptions. So if you take a look at this, it says, what do you pay each month? So right now, and this changes every year, you're paying $144.60 a month for your Part B. If you are a married filing joint, you're going to see, again, there's a dollar value. It's $174,000. So for some people, they're like $174,000. I'm not going to see, that's not going to be an issue, right? I would tell you that you're probably right. The most people that have issues with this IRMAA are people that have really great retirement savings and pensions, and they get themselves into these and the premium really jumps up quick. Or those Part 1 that are single and saved really well, never had any kids, Good. I have three of them, so I understand there's a massive cost there. So those that didn't have kids, or part two, when somebody dies. So if you are that surviving spouse and you had all the assets and all the required distributions, from the IRAs and all this stuff, and all of it's eligible for you, you might go from, hey, we were making under 174, we were making 150. All of a sudden, if your significant other passes away, you could actually go to this third or fourth tier down here and start paying almost double, if not more than double, for that same dollar value you're already paying for the same services. So the key being here with IRMAA is you need to sit down with somebody. You need to be careful of required distributions. I have so many clients that have dividends, required distributions, and they're not thinking about that when they take a look at these charts. It's a slippery slope, especially with individuals. You go from 87 to 109, it goes to $202 a month. From 109 to 136, $289 a month. So pause for a second. That is literally double what you were paying for an individual. So you went from 87 or less, 87,000 or less, you could make $110,000 and you could have double the amount that you have to pay for Part B. So crazy. So be really cautious. This is, I've taken on a lot of great clients over the years, especially individuals or those that had a spouse that passed away, because their financial professional was not looking at this. And they were like, man, down the road, I might have to pay double for the same service everybody else gets. Yeah, you got to be careful of that. Last but not least here, the ones that I really see, 136 to 163. So you went to 137,000 versus 87,000. You're now paying 376 a month. So that is almost triple what you would have been paying for the traditional $144 a month benefit. So the tough part too, if you look in the fine print, is this is the numbers for 2020, but it's based on your earnings in 2018. So pause and take a second to think about that. Let's say you retire at age 64 and you're looking at your Part B premium for age 65. What year, if you're age 65, do they look at for what your earnings record was? Your age 63, when you were working, when you were probably making your most amount of money. So be really, really cautious on this. There's some planning techniques to make sure that you don't run into any of this. I can tell you that as a CFP, I have seen so many people get caught up in this issue. Again, don't pay more for the same service. That just drives me crazy. So again, this is something we should talk about at IRMAA. Last piece here that I just want to cover with everyone is basics of retirement planning. So we've talked about Social Security, we've talked about healthcare, we've talked about a couple of these different pieces. Take a look at this chart and say, and really the key being here is good old school spending plan. I don't like to use the term budget, but I like to use the term spending plan. It's a little bit more fun. Take a look at what your monthly income needs are. Needs. What do you really need to cover? Not like I want to take a big, huge trip every single year. That may not be a need. But you should take a look at what you have coming in as Social Security for you and or your spouse or significant other. Take a look at any pensions or other things that you have, and anything that you have as a guaranteed income source. And if that fits your budget, pays all like the food expenses, the mortgage and the taxes and the insurances, if that covers that type of stuff, great, you're done. You're going to have a lump sum of money on the side. You're going to do great with that. That's a very few percentage of people. Most people, they take a look at that and they find out that there's a gap. So what I do with that gap, what I talk to clients about with that gap is take a look at what that gap is and then let's try to fill it, right? You've got this big chunk of money. It doesn't show it on the side, but you got this big chunk of money being a 401k, 403b, IRA, some sort of deferred savings plan. Let's take a look at that and try to create some sort of strategy around creating a paycheck to fill in that gap. That could be through some sort of guaranteed income source. It could be off of dividends. There's a lot of different ways to do it. As fiduciaries, we're doing it for your best interest. So if you came to me and said, how should I fill in this $2,000 a month gap? I'm going to give you the options. I'm going to tell you the pros and the cons, and I'm going to let you decide that, right? That's advised choice. I'm giving you the options on how to pick from your retirement future. My whole point there is to give you education, support, and give you advice on the investments. So in that scenario. So on the other side here, you're going to see this is discretionary expenses. I don't think you worked all these years to sit at your house and do nothing, right? I think you probably, maybe that's some of you guys, but for the most part, the whole point was probably to do something, spend time with grandkids, go on trips, go do that stuff on the bucket list that you've always wanted to get done. Those are must-haves, to have a good, healthy retirement. But those things can be taken off of lump sum assets. They can be taken off of your 401k or your IRA that's invested in the market after you retire, because you can delay that trip a year, right? You can prepay things to make sure you're in a good spot and you're not taking a chunk of money from an account, like we saw in March that were, huge drop in the market. So, but you can't take that same scenario and say, I need to live off of this. I need to have my food expenses. I need to have my monthly, expenses for taxes and insurances and things like that. You shouldn't be taking that off of a value that could drop so substantially. So, again, basics of retirement planning. I thought this was important to add in the slideshow. I think when we sit down for our one-on-one consultation, and again, I'll throw this up here, my Calendly. Everybody has it if they've got an email from me, which everybody has. And you're also going to get a follow-up from the company that I use to follow up as a next step with that same link. So you're going to get, people, kind of hounding you a little bit to get a time with me. I think it's worth the while. I don't charge anything for it. It's a free consultation. But I think you can get a lot of value add spending the half an hour with me, going over a little bit about your strategy, your plan. And if you're a good fit, if I'm the right fit for you, I would love to work with everybody, if it's the right scenario. So last but not least, here for slides, thank you so much. Thank you for being here. Thank you for bearing with me. I looked at the clock. It's been about 35 minutes. Thank you for being here, of actual slides. It's a lot. You've invested some time. That's part one. Make sure you invest the time and do part two, which is sit down with me. Spend the time, spend the 30 minutes, get a second opinion if that's what it is, or first opinion for some people. Some people just have never gotten the advice that they need. This is my Calendly here. I'll leave you with this last point on financial planning. All these little pieces that we've talked about, I think about where I am here in Tampa. If I were to go to Tampa to Orlando, I could probably figure it out, right? I could probably get on the right path. I might go over on 4 or something like that to try to get over that direction. If you mentioned a street in Orlando, I could never get to that, right? I would have no clue how to get to that place because, again, I would probably plug that in a GPS, right? So I want to leave you with this as retirement planning. You've always known that you've had to go in this direction, right? And you've been able to probably do it without some sort of planning, or at least really in-depth planning. But once you get to that end zone and you really try to figure out, okay, I need this as an income, I need this as a budget, I need to pay this off, how should I take this? Let me know a little bit more about taxes. That's like the street. You really don't know unless you really get a roadmap out. So I really entice everybody here to spend a few minutes, like I said, on that call. A lot of clients decide to take us on as financial planners and actually get some sort of written plan or game plan on how to get to that end destination, right? The end destination being a successful retirement. So thank you all for coming tonight. Here is my Calendly. You'll also, like I said, see that in the bottom of all my emails, as well as you're going to get follow-up from the firm that I use for all my digital marketing. So I really appreciate it. Thank you for spending the time. Hope to talk to you soon.